Welcome back to the Market Podcast. Asymmetric info for individual investors. Educational info only, not financial or legal advice. Consult a pro before investing.
Imagine a world where the sheer drudgery of repetitive tasks in your workplace, every single ticket, every approval, every single workflow just melts away, replaced instead by an incredibly efficient, intelligent, AI-driven digital symphony. This isn't some far-off futuristic vision. It's a profound transformation happening right now across global enterprises, completely reshaping how we work and how businesses operate. At the very heart of this monumental shift is a company you might not hear about on the evening news every day, yet it's quietly powering the digital backbone for thousands of organizations worldwide. This is a truly pivotal moment for them, as their future trajectory is intricately linked to one central question. Can this company truly lead the artificial intelligence wave in enterprise software? For anyone looking to understand the powerful forces reshaping industries, particularly through the lens of artificial intelligence, and to gauge if a certain titan is a promising opportunity or perhaps just a fleeting trend, this exploration is for you. This isn't merely a technical query, it's a high-stakes question for anyone following market movements, for you, the individual investor. We're going to dissect its leadership, its financial strength, and its competitive edge to bring you absolute clarity. Our mission today is to cut through all the noise and provide you with the most essential insights into this cloud-based workflow automation leader, revealing whether it stands as a robust contender in the AI landscape or perhaps a cautionary tale of overpromise. So let's unpack this. Our focus today is ServiceNow. And to truly understand ServiceNow, you first have to grasp its fundamental business model. Think of it like a digital conductor in a vast, complex orchestra that is a modern enterprise. What ServiceNow provides is a cloud-based platform known simply as the Now Platform, which is meticulously designed to automate and unify enterprise workflows. It acts as the digital glue, connecting disparate business processes and orchestrating a symphony of tasks across an entire organization, ensuring every instrument plays in harmony.
That analogy of the conductor is quite apt, actually, because it highlights how they bring cohesion to what is often, let's face it, a pretty chaotic environment in large companies. While the core concept of streamlining IT tickets or simplifying HR onboarding processes might seem straightforward, ServiceNow adds a truly sophisticated layer with its integration of advanced artificial intelligence capabilities. For instance, their Now Assist tools now deploy generative AI agents directly into those workflows. This isn't just about simple task automation. It's about context-aware AI that learns from, vast data sets of enterprise interactions. For an investor, the model is very clear. You sell subscriptions to enterprises, and those subscriptions become increasingly sticky as they find greater efficiency and demonstrable value.
And it absolutely has a unique edge in the market. Unlike broad software suites that try to be everything to everyone or platforms primarily focused on just customer relationship management, ServiceNow's strength lies in its ability to combine workflow automation with deeply integrated AI-driven insights. Crucially, it does this all on a single platform and at an incredible scale. Its unified data model is a significant advantage because it eliminates information silos, those fragmented pockets of data locked away in different departments or legacy systems. By breaking down these barriers, it enables real-time analytics and automation across front-office functions like customer service, mid-office operations such as HR, and back-office tasks like IT and finance. A prime example of this unifying power is its partnership with a major cloud provider for bidirectional data integration, showcasing its distinct ability to unify vast amounts of enterprise data in what remains a highly fragmented market. This isn't just about efficiency, it's about agility and providing a holistic view that very few competitors can truly offer.
That unified approach is, indeed, a critical differentiator. It's probably one of the most important things to understand about them. When we look at their distribution strategy, ServiceNow primarily uses a direct sales model, focusing on targeting large enterprises with dedicated account teams. This is a high-touch, relationship-driven approach. It's complemented by strategic partnerships with major consulting firms like Accenture, which reportedly has, I think, over 100 dedicated ServiceNow consultants, so big buy-in there. Their cloud-based delivery ensures immense scalability, meaning they can serve clients of all sizes with access to the platform via subscriptions that are often highly customized through additional professional services. They've even developed a personalized workflow portal called MyNow that significantly enhances customer engagement and drives adoption by making the experience more intuitive. With 8,400 global customers, including, get this, 2020, that generate over $1 million in annual contract value, their model clearly supports rapid scaling.
Oh, over 2,000 customers paying over $1 million a year. That's substantial.
It is, and it's evident in the 89 deals over $1 million they closed in just a recent quarter. It signals their continued ability to land and expand within large organizations. They get in, and then they grow.
Okay, so that large customer base and those big deals naturally lead to the next question. Revenue predictability. How stable is their income stream?
This brings us to a crucial point for any investor. Revenue predictability. It is incredibly high for ServiceNow. A remarkable 97% of their revenue in Q2 2025 came from subscriptions.
97%. That's almost entirely recurring revenue.
Exactly. This isn't just a nice to have, it's a foundational strength. Long-term contracts and an impressive 99% customer renewal rate ensure remarkable stability in their top line.
99% renewal. That's practically unheard of. Customers just don't leave.
They really don't. Furthermore, their current remaining performance obligations, or CRPO, which represents contracted future revenue, stands at $10.92 billion and grew 24.5% year-over-year.
$10.9 billion in future contracted revenue. That gives a lot of visibility.
A huge amount.
Yep.
This figure signals very strong future revenue, providing a significant degree of visibility. This inherent predictability provides a substantial shield against economic volatility, making ServiceNow a reliable consideration even in turbulent markets. It's a true testament to the robustness of their subscription-based model. It means less worrying about quarter-to-quarter swings and more confidence in their long-term trajectory.
What's truly compelling about ServiceNow is its journey of reinvention, a story that moves from, well, pretty humble beginnings to significant billion-dollar milestones. The company's journey actually began back in 2003, initially named GlideSoft, with a very clear vision to deliver cloud-based workflow automation. It was inspired by founder Fred Luddy's previous experience at Peregrine Systems, where he saw firsthand the inefficiencies of on-premise IT management. He envisioned a system that could manage tasks, incidents, and problems in the cloud, quite a radical idea at the time.
Indeed, a very forward-thinking idea for 2003. And the milestones tell a compelling story of adaptability and strategic foresight. Rebranded ServiceNow in 2006, the company went public in 2012, raising substantial capital to fuel its growth. While early success stemmed largely from its IT service management, or ITSM, offerings essentially helping companies manage their IT help desks and infrastructure, it smartly recognized the broader opportunity. The company strategically pivoted to broader enterprise workflows, expanding its platform into critical areas like customer service, human resources, and security operations.
So they didn't just stick to their original niche. They saw the potential to apply that workflow engine everywhere.
Precisely. Major financial milestones include surpassing $1 billion in revenue in 2017 and an impressive $10 billion in 2024. Propelled by a robust 26% compound annual growth rate in subscription revenue from 2020 to 2024.
26% CAGR over 4 years to hit $10 billion. That's serious momentum.
It is. This isn't just growth. It's consistent, compounding growth, indicative of a strong underlying demand for their platform.
And here's where it really gets strategic. A leadership transition in 2019, specifically the appointment of Bill McDermott as CEO, marked a decisive shift toward deep artificial intelligence integration. This pivot was accompanied by strategic acquisitions and pivotal partnerships that would redefine ServiceNow's market position. Despite facing macroeconomic headwinds, the global pandemic, supply chain disruptions, rising interest rates, their astounding 99% customer renewal rate, and that robust 24.5% year-over-year growth in CRPO highlight ServiceNow's incredible resilience. The company has deftly reinvented itself, moving from being primarily a niche IT offering to a comprehensive AI platform, positioning itself perfectly to capitalize on the accelerating global digital transformation trends that every enterprise is grappling with. It's a remarkable evolution, but the technology, no matter how powerful, is only as good as the minds behind it. So, let's turn our attention to the human element, because exceptional leadership and a strong culture are undeniably driving this innovation. ServiceNow's leadership team is a powerful combination of seasoned enterprise software veterans and strategic visionaries. At the helm since November 2019 is Bill McDermott, a charismatic leader with a proven track record of driving significant revenue growth and global expansion during his previous role as CEO of SAP. His arrival signaled a new era of aggressive growth and strategic clarity.
Absolutely. McDermott's strategic focus on AI integration is a cornerstone of their current success. You really see his fingerprints on this. This is exemplified by the rapid launch of Now Assist and pivotal partnerships with leading AI chip makers like NVIDIA and major cloud providers like AWS. This strategic positioning has firmly established ServiceNow as a formidable contender in the rapidly evolving AI-powered workflow space, Complementing this vision, the President and Chief Financial Officer, Gina Mastantuono, brings critical financial expertise, having successfully scaled the company's revenue past $10 billion and securing its well-deserved spot on the Fortune 500.
So the financial discipline is there alongside the vision.
Very much so. And amidst, appointed President, Chief Product Officer, and Chief Operating Officer in October 2024, adds over 3 decades of experience from major tech giants like Google Cloud and Oracle. He's leading product innovation like the groundbreaking Xanadu release, which introduced advanced AI agents directly into the platform. This is a team built for scale and innovation.
The board itself is equally impressive, including industry heavyweights with incredibly diverse perspectives. You mentioned Deborah Black, former VP of Engineering from Netflix, and Jeffrey Miller, CEO of JM Ventures. This blend of operational, financial, and technological expertise at the highest level ensures robust oversight and strategic guidance. McDermott's AI-focused acquisitions, such as Data.World, a leading data governance company crucial for AI strategy, and Mastantuono's disciplined margin expansion strategies demonstrate a leadership team adept at aligning innovation with profitability. They truly know how to integrate new capabilities while maintaining financial health, a rare balance.
It's important to acknowledge the founder's enduring legacy, too. ServiceNow was founded by Fred Luddy back in 2003, with that vision for cloud-based workflow automation. While Luddy is no longer heavily involved in day-to-day decision-making, having stepped back after the company's 2012 initial public offering, the current leadership under Bill McDermott exhibits traits of exceptional business acumen. There's a relentless focus on AI integration and customer-centric workflows that truly mirrors the passion often seen in founder-led companies, bringing that entrepreneurial drive even without the founder's direct daily involvement.
That's interesting. So the spirit is still there.
I think so. What's more, incentives are very well aligned with investors. A significant portion of Bill McDermott's compensation package is tied directly to stock and performance bonuses, linking his success directly to shareholder value. This creates a powerful shared interest in the company's long-term performance.
Their mission, to make the world work better for everyone, is clear and aspirational, aiming to unify and automate enterprise workflows through its Now platform. Its vision is to be the AI platform for business transformation, connecting people, processes, and data across industries. This isn't just a marketing slogan, it's explicitly reflected in ambitious initiatives like the Xanadu release, which strategically embeds AI agents to automate crucial functions like security and risk management, fundamentally transforming how organizations protect themselves and manage complex compliance.
And this aspirational mission directly translates into their culture. The company fosters a culture of innovation and deep customer obsession, with employees aligned around the clear goal of making work flow through AI-driven solutions. Programs like Mine Now, their personalized workflow portal, and that remarkable 99% customer renewal rate in Q4 2023 truly underscore a culture that prioritizes user experience and measurable outcomes for clients. While the vision for AI as a cross-industry unifier is explicit and incredibly ambitious, scaling this culture globally while maintaining agility and a consistent level of execution remains a test of their long-term capabilities. It's always a challenge to scale culture.
Moving to the core of their AI proposition, let's look at how they are concretely powering the future of work with their key offerings and AI integration. At its fundamental level, the Now platform is a comprehensive, cloud-based suite that automates workflows across all the critical operational pillars of an enterprise: IT management, human resources, customer service, and security. It's kind of like the central nervous system for business operations.
What is truly significant is how profoundly AI enhances these foundational capabilities. Key offerings in IT service management, customer service management, and security operations are all significantly enhanced by AI through Now Assist. Now Assist strategically deploys generative AI agents. And this isn't just about simple automation. These agents can perform complex tasks like proactively detecting security threats, intelligently resolving IT incidents by analyzing past solutions, and even drafting empathetic responses for customer service agents.
So it's augmenting human capabilities, not just replacing simple tasks.
Exactly. The platform has achieved very strong product-market fit, evidenced by those 528 customers with over $5 million in annual contract value, and that consistently impressive 99% renewal rate. These figures signal that once enterprises adopt ServiceNow, they find immense value and rarely churn.
Recent innovations really highlight their commitment to leading the AI frontier. Launches such as the Xanadu release, for example, introduced groundbreaking features like AI Control Tower for managing AI inventory and compliance, and digital operational resilience management, which significantly boosts security automation capabilities.
Can you unpack that AI control tower a bit? That sounds significant.
It really is. Think of the AI control tower as a centralized dashboard for an enterprise to oversee all their AI models, regardless of where they were built or run. For you, the investor, this is critical because it directly addresses a massive pain point in enterprise AI adoption, governance, and risk management. It helps companies ensure their AI is compliant with privacy laws like GDPR, check for bias, monitor performance, and manage the whole life cycle across the entire organization. It drastically reduces risk and should accelerate responsible AI adoption at scale.
That makes sense. Providing guardrails for this powerful new technology. Precisely. And their product roadmap is sharply focused on expanding these AI capabilities, with Now Assist alone targeting an impressive $1 billion in annual contract value by 2026.
1 billion ACV just from Now Assist by 2026. That's ambitious.
Very ambitious,
Yeah.
but it shows their confidence. Strategic acquisitions, like the data governance company Data.World, further enhance their ability to integrate and manage enterprise data, positioning ServiceNow for even broader and more sophisticated AI applications across different industries. This strategic foresight and disciplined execution are key to their long-term growth.
Now let's go behind the scenes to their global operations and supply chain. Headquartered in Santa Clara, California, ServiceNow boasts a truly global operational footprint across North America, Europe, the Middle East, Africa, Asia Pacific, and Japan. Key locations, including vital research and development centers, strategically support sales, engineering, and customer success worldwide. This extensive reach allows them to serve their diverse global customer base effectively and adapt to regional market needs.
What's notable is their lean operational model. ServiceNow primarily leases its facilities, ensuring flexibility and reducing capital expenditure. They don't own huge campuses. They strategically outsource non-core functions like data center management to major cloud providers, think AWS, Azure. This was a shift announced in 2025 specifically to enhance their AI delivery capabilities by leveraging the immense scale and advanced infrastructure of these providers.
So they leverage the hyperscalers for the heavy lifting on infrastructure.
Exactly. This global footprint supports their 8,400 customers and allows for rapid scalability, demonstrating a very efficient approach to infrastructure management. This strategy allows them to focus intensely on their core competency, software innovation.
So this company is not vertically integrated at all. Its focus is entirely on software development rather than building or owning hardware or core infrastructure. Its supply chain relies heavily on those major cloud providers for hosting their services. While this certainly reduces ServiceNow's operational complexity and capital requirements, it naturally introduces a dependency risk on third-party infrastructure.
That's true. There's always a trade-off. However, diversifying providers helps mitigate potential outage risks. And to date, no major disruptions have been reported that significantly impacted their service. They manage that risk quite well, it seems.
And they have critical partnerships too, right? Not just with cloud providers.
Precisely. Critical partnerships with leading AI compute power providers like NVIDIA, essential for training and running advanced AI models, and network security solutions providers like Cisco, further enhance their efficiency and extend their platform's capabilities without the burden of building everything from scratch. While this lean approach minimizes costs and allows for greater agility, it also means less direct control over the underlying infrastructure compared to some competitors who might choose to own and operate their own massive data centers. It's a strategic trade-off that has largely worked in their favor, allowing them to remain nimble.
This brings us to ServiceNow's enduring strength, its competitive advantages, and its formidable market position, what some might call its unifying moat. The company operates in a highly competitive enterprise software market, yet it holds a leading position in IT service management and workflow automation, commanding an estimated 40% market share in ITSM, according to Gartner. That's a dominant share. The market itself is oligopolistic, with a few dominant players controlling significant share. But ServiceNow's sharp focus on AI-driven workflows truly carves out a distinct niche. This focus protects its profitability through high switching costs and robust customer retention, making it very difficult for competitors to dislodge them.
And they leverage economies of scale in a very powerful way. Their cloud-based platform serves 8,400 customers at a remarkably low marginal cost. Think about it. Adding new users or even entirely new enterprise departments incurs minimal additional expense for ServiceNow, which significantly boosts their margins. These stood at a healthy 29% non-GAAP in Q4 2023.
29% operating margin is quite strong for a software company still growing this fast.
It is. This provides them a clear cost advantage over smaller competitors, allowing them to reinvest heavily in innovation and research and development, continuously expanding their lead in the market.
Their counter-positioning is also a critical differentiator. ServiceNow's unified data model and deep AI integration fundamentally differentiate it from competitors whose solutions are often fragmented point products or who rely on a patchwork of acquisitions that don't always talk to each other smoothly. Its recent partnership with a major cloud provider for real-time data integration, announced at Knowledge 2025, positions it uniquely against rivals who might focus more narrowly on specific areas like customer relationship management. This differentiation is a key driver of customer adoption, as seen in those 89 deals over $1 million in Q2 2025. Customers are choosing ServiceNow precisely because of its holistic, integrated approach to solving complex enterprise problems.
And that unified approach leads directly to very high switching costs for customers. Once an enterprise integrates the Now platform deeply across its various functions, say, automating both IT and human resources workflows migrating away becomes an incredibly complex, time-consuming, and financially costly endeavor. For a large Fortune 500 client, such a switch could mean months of disruption and retraining, facing not just a technological challenge, but a significant operational one. This deep integration effectively locks customers in, ensuring incredible customer stickiness and contributing to that impressive renewal rate.
It becomes embedded in the very fabric of how the company operates.
Absolutely. Their process power is equally impressive and difficult to replicate. ServiceNow's low-code, no-code development tools and AI-driven automation processes empower businesses to rapidly build custom applications and automate tasks without extensive coding expertise. Its App Engine, for instance, allows businesses to build custom applications reportedly 50% faster than traditional coding, according to analyst reports. That creates a significant quality and speed advantage.
So they empower citizen developers within the enterprise, broadening their impact.
Exactly. Furthermore, their proprietary technology is a key asset that underpins much of this competitive advantage. The Now platform's generative AI agents, particularly those embedded in Now Assist, are proprietary and aim to be significantly more effective in automating complex workflows than generic AI tools. The Xanadu releases AI Control Tower, designed specifically for managing AI inventory and compliance within an enterprise, is a concrete step towards this ambitious goal, though it's important to note that competitors are also making strides in integrating AI. ServiceNow's head start and focused development give it a distinct advantage here.
So how does ServiceNow sustain this remarkable growth and maintain its lead? Let's look at things like network effects, brand resources, timing, and speed. Do they have strong network effects?
The Now platform exhibits moderate network effects, I'd say. Its value genuinely increases as more users within an enterprise adopt it. Integrating human resources and IT workflows on a single platform, for example, significantly boosts data sharing and efficiency across departments. This internal synergy contributes directly to that impressive 99% renewal rate. As the platform becomes increasingly indispensable, the more it's used. It's more an internal network effect than a cross-company one.
Okay, that makes sense. And what about their brand? Is it a strong asset?
And speaking of trust, ServiceNow's brand is deeply trusted within the enterprise world, built on consistent delivery and innovation. This trust is evidenced by its inclusion on Fortune's Most Innovative Companies list. While it's not a consumer-facing brand that you'd recognize on a billboard, its high renewal rate and the consistent growth in large customer accounts reflect deep customer loyalty and confidence in its offerings where it matters most, in the boardroom and the IT department.
They also access unique and valuable resources, a key competitive differentiator. Notably, this comes through their strategic partnerships with leading AI chip makers like NVIDIA and major cloud providers like AWS. These partnerships provide access to cutting-edge AI compute and data integration capabilities that would be incredibly difficult and expensive to replicate independently. Their talent pool, including leaders with extensive experience from major tech companies, also represents a significant competitive edge, allowing them to attract and retain top-tier engineering and product talent.
This brings us to perfect timing, which is often crucial for market leadership. ServiceNow's deliberate pivot to artificial intelligence aligns perfectly with the current surge in enterprise AI adoption. Now, Assist was launched precisely as demand for generative AI capabilities soared, giving it a first-mover advantage in AI-driven workflows over many later entrants. They didn't just chase a trend, they anticipated it and built solutions that were ready when the market demanded them.
And their speed of execution is truly remarkable, allowing them to capitalize on that timing. Rapid product releases, such as the Xanadu release in 2024 and Utah in 2023, underscore their ability to move faster than many larger, more bureaucratic competitors. Strategic acquisitions and partnerships completed within a single quarter demonstrate exceptional agility, making it genuinely challenging for competitors to match their pace of innovation and market responsiveness. This isn't just about launching new features, it's about rapidly integrating them into a cohesive platform that delivers immediate value.
And finally, their cross-industry depth. ServiceNow's focus on cross-industry applications, spanning diverse sectors from healthcare to government, further broadens its market advantage. This isn't a company limited to a single niche. Its consistently high renewal rates and significant number of large contract value customers reflect deep market penetration across various sectors, a truly unique strength in what can otherwise be a fragmented industry with many specialized solutions. This adaptability ensures a diversified revenue stream and robust growth opportunities.
Looking to the future, let's explore ServiceNow's ambitious growth trajectories and the immense market potential still ahead. Their growth strategy is multifaceted, encompassing market penetration by expanding adoption of core AI offerings like Now Assist, market development by actively entering entirely new sectors such as healthcare and government, and continuous product development by enhancing its powerful AI agents and platform capabilities. It's a comprehensive approach designed for sustained expansion.
Strategic partnerships are central to fueling this growth. Collaborations with major cloud providers, leading AI chip makers, and network security companies, along with strategic acquisitions like the data governance firm Data.World, are all crucial. These partnerships and acquisitions are not just about adding features, they are about enhancing the platform's core capabilities, expanding its reach, and solidifying its position as the go-to solution for enterprise AI transformation.
They have truly proven potential to execute on this vision. ServiceNow is actively targeting new markets like government and healthcare, with its AI-powered solutions already driving significant growth. For example, they've seen 50% year-over-year growth in their field service management annual contract value. That's a specific area seeing huge uptake. Past successes, like crossing $10 billion in revenue, strongly suggest its capacity for strong execution moving forward. They have a blueprint for scaling and an established track record of hitting ambitious targets.
The Now Platform's wide-ranging applications across IT, human resources, customer service, and security enable substantial scalability. For instance, its healthcare solutions are designed to improve patient experiences by streamlining everything from appointment scheduling to claims processing, while its government offerings aim to modernize public services by automating complex administrative tasks. This broad applicability effectively expands its addressable market significantly, allowing it to penetrate diverse industries with tailored, high-value solutions.
The core drivers of their growth seem clear then. Rapid AI adoption across the enterprise landscape, with Now Assist alone targeting that $1 billion in annual contract value by 2026. Those strategic partnerships we discussed, which provide access to cutting-edge tech, aggressive cross-industry expansion, its exceptionally high customer renewal rates, which create a very stable revenue base, and its inherently scalable subscription-based business model, which allows for compounding growth.
This all points to an expansive opportunity, with a truly massive total addressable market. ServiceNow's total addressable market is estimated at a staggering $220 billion. That covers IT service management, customer relationship management, and AI operations markets.
$220 billion, that's enormous.
It is. This isn't just a big number. It represents a vast ocean of potential growth.
And here's the kicker, the truly compelling part for investors. With only 8,400 customers out of a potential 100,000 plus enterprises globally, ServiceNow has substantial room for growth. This is particularly true in the domain of AI-driven workflows, which are projected to grow at a 25% compound annual growth rate through 2030. That's a massive long runway for expansion, indicating they've only just begun to tap into their full market potential. So how does ServiceNow navigate the landscape of risks, resilience, and broader macroeconomic factors? First, let's look at how it fortifies against potential challenges. Its cloud-based model relies on multiple major cloud providers, which significantly reduces physical supply chain risks associated with owning and managing vast server farms. However, this does introduce a dependency on third-party infrastructure. But critically, diversifying across multiple providers helps mitigate potential outage risks, and to date, no major disruptions have been reported that have significantly impacted their core services.
What's important to recognize is their highly diversified customer base. With 8,400 customers spanning government, healthcare, finance, and technology, ServiceNow's customer base is exceptionally diversified, significantly reducing reliance on any single sector or industry vertical. Its 2020 customers, with over $1 million in annual contract value, are spread across multiple geographies, further enhancing stability and buffering against localized economic downturns. This broad base is a key factor in their resilience.
The company exhibits what we call anti-fragile traits. This is a concept popularized by Nassim Taleb, where something doesn't just resist shocks, but actually gets stronger from them. For ServiceNow, this means the very chaos and complexity of enterprise digital transformation. The urgent need for companies to modernize legacy systems and automate everything isn't a threat. It's a massive tailwind. The more fragmented and inefficient an enterprise's operations become, the more value ServiceNow's unifying platform provides, allowing them to capitalize on the increasing demand for automation that truly surged post-pandemic. They thrive in environments of uncertainty by offering solutions that bring order.
That's a really interesting way to put it, anti-fragile. And it leads to an important point about their long-term longevity. ServiceNow is exceptionally well-positioned to capitalize on secular trends, such as ubiquitous AI adoption and widespread digital transformation, which are irreversible forces in the modern economy. There is a high probability of it remaining relevant long-term due to its scalable platform and broad cross-industry applications. It has demonstrated its ability to weather economic downturns, as shown by its strong CRPO growth even amidst recent economic headwinds. This isn't just a company for today, it's built for tomorrow. Despite all that inherent resilience, there are always potential headwinds and risks to growth that any investor must consider. A potential risk is market saturation in its original IT service management segment, where growth might naturally decelerate as it approaches full penetration. You can't grow at 40% forever in your most mature market.
Right, that makes sense. And they face fierce competition from other major players in the enterprise software space, including tech giants with broader ecosystems and deep pockets, which certainly poses an ongoing challenge. Keeping ahead in this race requires continuous innovation and strong execution.
There are also inherent integration risks associated with its strategy of acquiring other companies. While acquisitions bring new capabilities, effectively integrating technologies, cultures, and customer bases can be complex and sometimes lead to unexpected challenges, a common dynamic in growth through acquisition. Data.World seems like a good fit, but execution matters.
And then we have the known and unknown uncertainties. Known unknowns include the ever-present competitive pressure from the rapid AI advancements of other tech giants and potential regulatory changes impacting software as a service, or SaaS, pricing models. Unknown unknowns could involve truly disruptive open-source platforms emerging unexpectedly or unforeseen geopolitical impacts on the global cloud infrastructure that ServiceNow relies upon. These are factors that are harder to predict or control.
Turning to the broader economic picture, macroeconomic impacts are always a factor, though ServiceNow's model offers some insulation. Rising interest rates, for instance, increase borrowing costs for ServiceNow's minimal debt, though its robust free cash flow largely mitigates this impact. Higher rates could, however, lead to a slight reduction in overall customer IT budgets, potentially putting minor pressure on growth rates. As companies tighten belts, we might see deal cycles lengthen a bit.
Global trade tensions, particularly between major economic powers, could disrupt cloud provider operations, thereby affecting ServiceNow's underlying infrastructure and potentially impacting service delivery in certain regions. However, its global footprint and diversified cloud providers help reduce this exposure, spreading the risk across different geographies and vendors.
Persistent inflation can squeeze enterprise IT budgets, potentially slowing adoption of new services or leading to renegotiated contracts. ServiceNow's high-margin subscriptions with a healthy 29% operating margin provide a significant buffer against such pressures, but pricing pressure can certainly emerge if inflation continues persistently. It's a factor they monitor closely.
And the company does face currency risk, as evidenced by differences between reported and constant currency growth figures, highlighting the impact of foreign exchange fluctuations on its international revenue. Its strategic shift to leveraging specific cloud providers helps reduce infrastructure costs, boosting overall resilience against these factors by optimizing their operational expenses globally. Now, let's turn to the financial pulse and investor sentiment because the numbers always tell a compelling story. In Q2 2025, subscription revenue reached an impressive $3.1113 billion, marking a healthy 22.5% year-over-year increase. This robust growth was driven by widespread AI adoption across their customer base and continued customer expansion, including those 89 deals over $1 million in annual contract value. Total revenue hit $3.215 billion, reflecting robust overall demand for their platform.
Their profit margins are also remarkably strong, demonstrating excellent operational efficiency. Non-GAAP operating margin was 29.5% in Q2 2025, exceeding guidance by a notable 250 basis points.
Beating guidance by 2.5 percentage points on margin is significant.
It is. This showcases impressive efficiency in converting revenue into profit. GAAP net income was $262 million, up a solid 20% year-over-year, indicating healthy bottom-line growth alongside their top-line expansion.
If we look at the rule of 40%, a crucial benchmark for software as a service or SaaS companies, it essentially gauges a company's combined growth and profitability. The idea is that these two metrics, revenue growth and operating margin, should add up to 40% or more for a healthy, balanced growth company. ServiceNow, with its 22.5% revenue growth and 29.5% operating margin, yields a score of 52.
52, that's well above the 40 threshold.
Exactly. This isn't just a good number, it's a strong indicator of both deep product market fit and overall financial health, showing they're expanding rapidly and efficiently. It's a mark of a well-run SaaS business.
Their capital efficiency is also noteworthy. ServiceNow's estimated return on invested capital, or ROIC, is 15%, reflecting efficient capital allocation. While this is slightly below some hypergrowth peers, it's still a strong figure, especially considering their ongoing heavy investment in research and development. This investment is crucial for maintaining their competitive edge in the rapidly evolving AI landscape.
They also have healthy cash reserves and remarkably low debt. Their current ratio of 1.1 indicates adequate liquidity to cover short-term obligations, a sign of financial stability. Even more impressively, their debt-to-equity ratio is a very low 0.2, which is quite favorable for a technology firm, especially supported by its substantial $2.5 billion in annual free cash flow. This low leverage provides immense financial flexibility for future investments or acquisitions.
Free cash flow growth was up an impressive 300 basis points year-over-year to a 16.5% margin. This provides ample funding for future strategic acquisitions and continued research and development without having to rely heavily on external financing. Their key customer metrics, current remaining performance obligations of $10.92 billion, representing 24.5% year-over-year growth, along with 528 customers with over $5 million in annual contract value, consistently highlight strong customer stickiness and significant traction in its AI initiatives, promising continued robust financial performance. Okay, so strong financials. How do they stack up against their peers? When we compare ServiceNow to its peers, its 22.5% revenue growth outpaces some larger rivals like Salesforce, which is growing, I think, around 10% currently. But it does lag behind hypergrowth data cloud companies like Snowflake, which is closer to 30% growth. So this positions it squarely in a strong growth category for its size and maturity. Faster than the giants, slower than the hypergrowth players.
However, its 29.5% operating margin is highly competitive with a major software competitor like Microsoft, known for its profitability around 30%, and it's well ahead of another large customer relationship management provider like Salesforce, which typically sits around 25%. So, best-in-class margins for their growth profile.
Pretty much. This demonstrates superior operational leverage and efficiency within its segment. And its low debt combined with high free cash flow give it a distinct financial advantage over more leveraged competitors like Oracle. Overall, revenue and CRPO growth have consistently exceeded 20% year-over-year since 2020, driven by the strong demand for AI and its cross-industry expansion. Margins have also steadily expanded, reflecting their growing scale and operational discipline. These are all very positive indicators.
So what's the investor viewpoint? What's the market chatter around ServiceNow right now? Its Q2 2025 earnings, released in July 2025, clearly surpassed expectations, reinforcing its strong subscription revenue and CRPO figures. Looking ahead, investors should keep a close eye on upcoming major events, specifically the Knowledge 2026 event set for May 5th to 7th. This is where ServiceNow typically unveils its newest AI features and platform advancements, and such announcements could further drive customer adoption and investor enthusiasm. Key updates to monitor include progress on its Now Assist $1 billion annual contract value goal and the full integration of its recent acquisition, Data.World, into the broader platform.
Commentary from individual investors online reflects a mixed sentiment, which is common for a high-growth, high-valuation company. Positive discussions highlight optimism about its strong AI integration and impressive earnings performance. No question about the execution recently. However, some investors note a period of stock price stagnation despite these strong earnings, questioning the market's full belief in its long-term AI narrative, or perhaps suggesting the valuation got ahead of itself.
Right, the stock hasn't moved much despite good news.
Exactly. Concerns also revolve around intense competition from other tech giants who are also heavily investing in AI, and the stock's relatively high valuation, with a price-to-earnings ratio that can feel stretched at, say, 80 times earnings. Despite these concerns, many view its consistently high renewal rate and strategic AI partnerships as strongly bullish signs. The overall sentiment remains cautiously optimistic, I'd say. AI is undeniably driving growth, but valuation and competitive pressures present areas of doubt for some.
Finally, let's talk about the price tag, its current valuation. As of August 1st, 2025, ServiceNow stock price stands at approximately $820 per share. Valuation is absolutely crucial because it helps you, the individual investor, determine if a company's stock is over or undervalued, guiding crucial investment decisions. An overvalued stock risks a correction, potentially leading to losses, while an undervalued one offers compelling potential upside. For portfolio managers, valuation deeply informs capital allocation. For you, it signals whether there's an attractive opportunity or perhaps elevated risk.
When we approach valuation, we typically use different methods to triangulate a fair price. For intrinsic value, we use a discounted cash flow model. Projecting ServiceNow's free cash flow, which stood at a robust $2.5 billion in 2025 and is estimated to grow 20% annually over the next decade, discounted back to today, suggests an intrinsic value of approximately $900 per share.
So $900 intrinsic value versus an $820 price. That suggests some modest upside based on DCF.
Correct, based on those assumptions. It implies it's not wildly overvalued, maybe even slightly undervalued intrinsically.
In terms of relative valuation, comparing it to its peers, ServiceNow's price-to-earnings ratio is indeed high compared to some mature software companies. We mentioned that PE of around 80. However, its strong, consistent revenue growth and leadership in a rapidly expanding market segment certainly justifies a premium over slower growth companies. Its price-to-sales ratio aligns more closely with other high-growth SaaS companies in its category. Key metrics for SaaS firms include enterprise value to revenue and the Rule of 40 score, both of which suggest strong underlying fundamentals. However, these metrics also indicate a potentially stretched valuation, suggesting that a good portion of its future growth is already priced into the current stock.
That's the tension right there. Strong fundamentals, but a valuation that reflects high expectations.
Now, let's consider both sides of the coin. The bear versus bull theses. Skeptics, or the bears, argue that ServiceNow faces intense and growing competition from larger tech giants whose broader ecosystems could potentially erode its niche over time. Think Microsoft, Google, perhaps others entering the workflow space more aggressively. Its high price-to-earnings ratio and reliance on major cloud providers expose it to infrastructure risks and potential margin pressure if cloud costs rise. Concerns also exist about stock price stagnation despite strong earnings, suggesting the market might be factoring in these risks. Broader macroeconomic risks like persistent rising interest rates and currency fluctuations could also slow overall enterprise IT spending, potentially capping growth.
Proponents, the bulls, view ServiceNow as a clear market leader in AI-driven workflows, operating in a massive and expanding addressable market, bolstered by that nearly perfect customer renewal rate that ensures remarkable durability and predictable revenue. Its strong current remaining performance obligations, growth, and strategic partnerships position it perfectly to capture significant future AI demand. Optimism points directly to its AI momentum, with its Now Assist feature specifically targeting $1 billion in annual contract value by 2026, a tangible and ambitious goal. Its low debt and robust operating margins are seen as strong financial pillars, supportive of long-term upside and providing crucial flexibility for continued investment.
The most probable outcome, in our view, leans toward the bullish perspective, given ServiceNow's consistent revenue growth, its exceptional customer renewal rate, and clear accelerating AI traction. However, its current high valuation suggests that significant upside may be tempered, meaning that for the current price to be fully justified, its AI initiatives will need to deliver truly exceptional growth and flawless execution. There's less room for error at this valuation.
This also directly impacts your margin of safety. At its current price, ServiceNow trades at a modest discount to its estimated intrinsic value based on our DCF. However, its high valuation multiple and the competitive risks we've discussed suggest it isn't a deep value play. You're not buying it cheap. This aligns with the bullish perspective that it's a strong company, a leader, but it demands flawless execution on its ambitious AI strategy to fully justify the current price and unlock further appreciation. It's a quality company, but one where much of the future is already discounted.
So, when we revisit our big question, Can this company truly lead the artificial intelligence wave in enterprise software? The answer is a qualified yes. It stands as a top contender, though perhaps not an undisputed champion in every single facet of the broad enterprise software market. There's too much competition for that. Its platform, with its increasingly AI-driven features and powerful strategic partnerships, positions it as a frontrunner in automating complex enterprise workflows, a truly critical and high-value application of AI that directly impacts productivity and efficiency. The strong revenue growth, the exceptional renewal rates, and the significant future revenue signals reflect robust demand and deep customer loyalty. Its newest releases and strategic acquisitions continue to enhance its AI capabilities, aiming for ambitious targets. With a vast addressable market and a significant runway for growth, particularly in AI-driven workflows, its unified data model and cross-industry applications give it a distinct edge over many competitors. However, its premium valuation and the relentless competition from other tech giants temper its overall appeal, making it a strong yet not risk-free consideration for your portfolio.
The bull case ultimately hinges on ServiceNow's ability to flawlessly execute its ambitious AI vision. Its partnerships and rapid product releases demonstrate impressive agility and a clear commitment to innovation, while strong operating margins and substantial free cash flow provide crucial financial flexibility to invest heavily in its future. The leadership team's ability to align innovation with pressing market needs is clear and proven. Bill McDermott has delivered. Yet, critics rightly highlight risks. Major competitors' AI advancements and broader ecosystems could potentially erode its niche over the long term, and its current valuation leaves very little room for operational missteps or a slowdown in growth. While broader macroeconomic headwinds could slow enterprise IT spending, ServiceNow's remarkable resilience positions it well. Its anti-fragile nature, the ability to not just withstand but actually thrive amidst the chaos of digital transformation, certainly tips the scales toward the optimistic view. But for you, the individual investor, the current price demands careful consideration and an understanding of the precision required for it to continue its upward trajectory.
So what does this all mean for you? This company's competitive advantage fundamentally lies in its unified platform, which masterfully eliminates data silos, a persistent, costly pain point for enterprises. This provides a form of asymmetric advantage. While many competitors offer fragmented point solutions, ServiceNow's holistic approach demonstrably drives superior efficiency and a single source of truth for critical operations. So as AI continues to reshape how we work, what specific, perhaps overlooked data point or emerging trend might further confirm or challenge this asymmetric advantage? And how will you leverage that insight in your own ongoing exploration of the future of enterprise software? We leave that thought with you.
Love this? Drop a like, subscribe, and ring the bell so you never miss a podcast.